Today I'm speaking with Jason Buck. He's the CIO of the Mutiny Fund. He specializes in volatility, options hedging, and portfolio construction. I wanted to speak to him because I really like the concept of the Cockroach portfolio. So he's designed a portfolio that can survive in many different kinds of environments. So yeah, I'm looking forward to talking to him today. So welcome to the podcast, Jason.
Thanks for having me here. I'm excited to have a fun conversation. It'll be interesting to see how I can tie it into value investing, but I guess it's all value at the end of the day.
So yeah, I mean, I usually go with all kinds of different investing approaches on here, and I have like an account where I do a lot of value investing, and then I also am very into the concepts that I think you're into of trying to create a robust portfolio for different environments. So I think we're aligned there. So to start things off, like what's your origin story? How'd you first get interested in investing?
Trying to think where to start. I think like a lot of investors early on, I think when I was 13, I convinced my dad to open up a trading account for me because I wasn't of legal age. And I can't remember where I read it, maybe in The Economist or something like that. It was something about, China was opening up because God, when I was 13, this has to be just at the end of the 80s. And my dad was already doing business in China. He had like a machine tool shop. But I remember reading that, China's opening up and they don't have Western style toilets and American standard toilets were going in there. So I was like, this is genius. Like this is my road to riches. And I was 13 years old and I started buying up American standard stock. And so, just like, I mean, probably, I don't know, 10 to $100 worth. It probably wasn't much. Can't really remember what happened to that necessarily, but yeah, that was my first kind of foray into investing in general. And then probably in my late teens, I came across Jack Swagger's Market Wizards books that are primarily about commodity traders or trend following managers. It kind of goes across the broad swath of managed futures. Fell in love with those books. Started trading options and other tech stocks in the late 90s, as most of my cohort did. Amongst that age, while you were in college classrooms, kind of slinging tech stocks, thinking that was your road to be a billionaire by the time you were 22. Then you learn the hard lessons of what the crash looks like. And then outside of that, I've always just been an entrepreneur, from selling stuff in my classrooms as a little kid to eventually running a commercial real estate development company in Charleston, South Carolina. I was always much more entrepreneurial. And, throughout history, I've traded futures, options, stocks, kind of the broad swath of the industry from both, publicly and privately traded asset classes.
Very cool, very cool. I love the Market Wizards books. They're pretty fascinating. Something I always got a kick out of. So I read like the 1989 one, and it's kind of funny how bearish everybody was in the book. Like they're all talking about like
Yeah.
this boom has been so crazy and it's bound to collapse. It's all totally wrong. I always thought that was pretty funny.
Did you ever see Paul Tudor Jones's Trader documentary? Have you ever seen
Oh
that?
yeah, yeah. It's yeah. So
That's
he did a chart comparing the 80s to the 20s and was convinced it was going to be like the 30s and the 90s. Yeah.
Yeah, so like to your point, like everybody loves that story of Paul Tudor Jones of like how he made so much money off the 87 crash. But the very like last 2 minutes of that documentary is exactly what you said. Like he thought this was going to be the worst recession in history in the late 80s, early 90s. And of course that didn't come to pass, but also shows you how hopefully traders, change their minds. And so you shouldn't really listen to them too much when they have global macro predictions.
Yeah, absolutely. Because I mean, Paul Tudor Jones, he's definitely been successful past the 90s. So I doubt he went all in on that Great Depression 1990s trade. So he was definitely flexible enough to change. I also wonder if that's like why he tries to suppress that documentary. Because every time it pops up on YouTube, he's always kind of giving them some kind of cease and desist, and it goes down pretty quickly.
Yeah, and I've watched it several times, but it's maybe been a few years since the last time I saw it pop up. So yeah, I need to maybe come through that too, because I don't know if he's trying to suppress everything or maybe just because it's dated. I'll have to go through watch it again, see if he says anything there that like in the 80s might have been acceptable, but now in 2024, in hindsight, maybe could get canceled for it. So maybe it's something like that. But like I'm actually I'm impressed, like we were talking about before we jumped on, is your anonymity is like, I think it's interesting that people, well, Paul Tudor Jones is just recently in the media again doing interviews, but I think it's much more interesting to always be like a private Swiss gentleman. And maybe I would pay to like have the internet scrubbed of any presence of me if I was somebody like PTJ, but that's just me.
Yeah, yeah, maybe that's it. So I know that you were an entrepreneur and you started as a commercial real estate developer, and you were a commercial real estate developer through the financial crisis. So how did that whole experience influence your investing philosophy?
Yeah, so I developed along the King Street corridor in Charleston, South Carolina, which is a great commercial corridor. But I was lucky in the sense that there wasn't a single national chain store when I moved to Charleston. And I played soccer at College of Charleston, is how I ended up there. So as I was going to develop these properties, there was a lot of, not a single, a lot of mom and pops on the ground floor. And seeing how they had a hurricane in the 90s that kind of decimated the city, a lot of the buildings were relatively vacant for their second, third, and fourth floors. So it was kind of a interesting space and time where you were buying on cap rates, but they were only based on, the retail ground floor, and everything above it was just vacant, basically. So I could take ideas from San Francisco, New York, or London, and, Charleston was behind the times, kind of plug and play them into developing property in Charleston. But what I found is, when you're developing commercial real estate or, really any business in general, you have to have a long-term vision. And even over the short to medium term, you're going to have to look 2 to 5 years out, right? If you're developing a property that needs a full rehab and you're doing it in a historical city center, just due to all the regulations, it's probably going to take you a few years. So when you work on like your pro forma or your projections of what the property's eventually the P&L is going to look like, you're usually projecting 2 to 5 years out. And when you do that, this is why I hate pro formas, because they're all lies. You're trying to predict the future, and part of the future you're predicting is it's going to be relatively the same as the current environment, and or like a low volatility, kind of steady state environment. It's kind of ceteris paribus when you're doing a pro forma. The worst thing that can happen to you when you're working on any sort of business project over a medium to longer term time horizon is if volatility picks up or liquidity dries up in a global macro sense. And that's what I had to learn the hard way. So I'm developing these properties, and I have multiple projects going on at the same time. They have anywhere from 6 months to say 6 year time horizon. And the great financial crisis happens, right? And I always say it's 2007 for real estate guys and 2008 for stock guys, because everybody talks about GFC being in 2008 because that's when they saw usually their retirement accounts go down. But we saw the cracks and the crash in 2007 in the real estate markets and at the mortgage lenders. And so the absolute pain of that environment, and it's so easy to kind of gloss over in hindsight, but it probably took me, years to come out of maybe a deep depression and after that, because it's one thing when you have projects that don't do well and maybe you have to, do workouts at the bank and everything. But when you've had family and friends invest in you and believe in you for years, and then you lose their money as well, that's really devastating psychologically to you. And you go from this high of thinking, you're Midas and everything you touch turns to gold, to thinking you're just an absolute idiot and you've ruined your life and maybe some of your family and friends. But in hindsight, you realize too, it's just money. And, as long as everybody's alive and healthy, that's what really matters. But why I bring that up is the pain of that environment made me realize there's got to be a way to hedge your kind of global macro risk as an entrepreneur or a business owner. And what I mean by that, like I was saying, is like, nowhere in my pro forma was a global liquidity crunch like the great financial crisis was. So when you're dealing with a local business or a local project, you have a very idiosyncratic viewpoint as an entrepreneur. And then so you can know your regional base when you're building your business. You can know your clients and customers and all those sorts of things. You can know your kind of local market or your idiosyncratic market. You can have your idiosyncratic vision, and you can be really good as an entrepreneur. But if we have a global liquidity crunch, it doesn't matter how good you are, you might just get swallowed up in that global macro wave. And so part of that, I thought there had to be a way to maybe hedge that. Most people told me it wasn't possible, but I also became obsessed with like Nassim Taleb and tail risk hedging. And so I went out and taught myself. I'd already been trading, like I said, managed futures and options since I was a teenager. But this really got me to buckle down, because to add insult to injury, while the real estate market was drying up and that global liquidity was drying up, I also knew who the worst mortgage lenders were, right? Your Countrywides, your Washmuse, your First Centuries, all of those back then. And so I was buying put options on those mortgage lenders. So in a time when they were crashing, right? And so I should have made a fortune. Unfortunately, I ended up losing money. I mean, just to add insult to injury, is because I didn't really fully understand my options Greeks, my theta bleed, those sorts of things. And I was buying options that were too far out of the money and too short of a time horizon or tenor. And I was paying up too much on the implied volatility. And so, even trying to short the housing market, I ended up losing both ways. I lost on the properties, then lost on shorting the housing market. So that kind of pain, and, I don't recommend pain for anybody, but that's usually the greatest learning experiences. So coming out of that, I had to really self-teach myself and really reach out to people broadly to really learn a lot more about options trading, futures trading. And, over that time horizon, I even developed some ideas around an intermarket spread between VIX and S&P way before that became popular, around like 2011, 2012. And so I was just kind of trading these markets myself. And over that time horizon, I started to follow a lot of the other traders in the long volatility space. And we can get into like kind of what long volatility is, but the idea was, the space is kind of, it was a nascent space. There wasn't a lot of players in that space. Even now today, there's probably only 30 to 40 players. And then we know all of them. But the idea was, as I'm learning about volatility trading and options trading, I started reaching out to the community and talking to a lot of players in the community as well. And over time, what I realized is, I was really starting to build out and hedge these portfolios for my family and friends. But then other people were asking, I've read Nassim Taleb, like, how do I hedge against black swans? And what they don't realize is this is an institutional asset class. And I go, do you have $150 million? And they're like, no, of course not. And they're like, well, you're screwed because those firms that are associated with Taleb and others, these are institutional asset classes, and they start at $150 million of notional S&P exposure. Usually it's billions of dollars of exposure for them to even take you on as a client. And so what I came to realize is like, I'm probably a much better entrepreneur than I'm a trader. Like I probably don't need to stare at a Bloomberg all day. So I figured there had to be a way to help out people like my friends and family that maybe weren't, institutionalists, or they weren't, single family offices, but they aspired to maybe one day be there, or they really just wanted to hedge their portfolios. So it took several years of trying to figure that out and what that vehicle could look like. And, eventually meeting my business partner and everything. And we've ended up launching in 2020 as a commodity pool operation to be able to allow accredited investors access to these kind of products.
Gotcha. So, I mean, the main inspiration there for the Mutiny Funds is basically trying to create a vehicle where, sophisticated investors who aren't necessarily institutional have the ability to access these kind of like higher level strategies in their portfolio. Is that right?
Yeah, so basically, when I'm sure we'll get into this further, but I think when people look at their investments, and I hesitate to even say investments because it's really your savings. So you should think about it more as savings than necessarily investments to make money off of. But
I
when
like
people
that.
are shown by their like financial advisors or whatever, they're shown that pie chart and they go, look, you're broadly diversified. And I go, no, you're not. Those are entirely offensive assets, right? And then when we have a liquidity event like March of 2020, as they say, correlations go to one, those all go down together. So it's like a conditional correlation, right? During the good times, they look like they're fairly uncorrelated. They tend to, have kind of higher betas of correlations to each other anyway. But when you have bad things happen, like a liquidity event or inflation or recession, all of those things go down together. So I think the biggest piece that for most people is missing is this defensive asset class. And so that's why we try to focus on providing the defensive asset class. Because like we say, like offense plus defense wins investing championships. And then, like I was saying, from my background, I look at it a little bit differently. Although I think you should have defensive asset classes in your portfolio, I look at maybe my life a lot more holistically as an entrepreneur and business owner. And I don't think entrepreneurs and business owners, if they do have any of these savings left over that they can't plow back into their business, I don't think they should be buying offensive assets that have a high beta to the rest of their business. They should actually only be using their savings for defensive assets, because if these things can make money during liquidity crunches or recessionary environments or inflation, then you have a much more ability to then outcompete your competitors because you had this defensive posturing that allows you to have cash when you need it most.
Yeah, absolutely. Yeah, with the offensive, like the offense asset classes, I think people got lulled into a sense of security in the early 2000s. Because, like, if you owned a portfolio of like REITs and small cap value
Yeah,
and some
yeah.
more defensive things, like, and you just kind of had minimized your exposure to like large cap growth, you sailed through that early 2000s thing just fine. But that kind of approach did not help you in '07 to '09.
No, and
Yeah.
as you know, like even the entirety of the 2000s, you ended up underwater in stock
Hmm.
positions. And then like you said, you try to diversify into REITs and everything, but like REITs have a high beta to stocks, especially in a down environment, right? They still are a stock, they're a security, right?
Right.
And so they are going to have a high correlation to stocks in a sell-off. And so yeah, that's what we try to, you try to diversify, but you have to maybe think about your asset classes a little bit more holistically. And maybe those are sleeves inside a highly correlated asset class.
Gotcha. Yeah, that makes a lot of sense. Now, how do you feel like about investors who try that diversification approach, but consider things like private equity or venture capital to be proper diversification against this kind of like, what do you think about that, approach to
So
diversification? It's kind of in vogue right now.
Yeah, so this is it's very interesting because from money aspects, but that's just leveraged equity and debt. We've always called it like you're either an equity or debt, and I think Howard Marks came out recently and like he's trying to say you're either in ownership or debt, and so he's trying to change it, but like you're either an equity or debt, right? And so private equity, venture capital are just leveraged up equity, right? And private credit is leveraged up debt. And similarly, kind of in real estate, whether you're providing that credit in debt or you're doing other leverage versions, is all of those things are still offensive asset classes. It's so funny how like it almost sounds like you're saying like it's offensive to you, but like versus offense. But that's like trying to think about like
Yeah.
saying that in general. But like so those are all relatively correlated, right? And like I said, when liquidity dries up and there's a credit crunch, they all go down together or in a recessionary time. And so those are just high-powered versions. The other way to look at it is what Cliff Asness always said, is it's volatility laundering. The only reason to have it private is because you get to create a mark to model instead of a mark to market, and it looks like you have no volatility or drawdowns until you have to really truly take that mark and that drawdown, and then it looks horrendous. So you might have something that looks like it hasn't had any drawdowns in the last 10 years, and then when you get forced to actually have a provide a mark for it, it might be down 70 to 80%. So that's why you've been like, like volatility can't be destroyed. It only gets transmuted. And so eventually it's going to come home to roost. And it looks like you had a low vol thing, but then it explodes into a high vol thing when you apparently you need it most.
Gotcha. Yeah, that makes a lot of sense. So thinking about downside, so a lot of investors, especially today, are only focused on the upside potential of an investment. Why is it important to focus on the downside?
So this is an interesting question. Since 2010, so the last 15 years, what do you think the multiple is for the S&P 500? How much is it up? Not to put you on the spot.
It's up about, I think, 100%, and we go from like 15 Schiller P to like a 30 now, like
Oh, that's not
doubled.
multiples, but actually on the actual returns, it's 10x.
Oh, yeah, for with
Yeah.
the earnings growth and everything. Yeah, I'm just talking about the
Yeah.
multiple. Yeah.
Yeah, no, I got you on the multiple, but like, so I don't think people have really thought that through. That since like 2010, we're up 10x in the last 15 years because I
hmm
think it's like a 15+% CAGR over the last 15 years.
hmm
And so, one, I'm an idiot to tell you you need defense, right? You should have just been plowed into the S&P for the last 15 years, but that's a hindsight bias, right?
Yeah.
And it's one of the most remarkable runs in world history. Like, do you think it's going to continue? So the whole point to us of having defense is like bad shit happens and we don't know when it's going to happen. But we're not perma bears, right? Like I want you to hold those offensive asset classes. I want you to hold the S&P 500. But what we do know from history is like you can't sustain a 50 to 60% drawdown. Most likely people go, well, I looked at a 100 or 200 year chart for the S&P 500 and it's up and to the right, so I should just hold it forever. That's what everybody tells me. But
hmm
this is a problem of sequencing risk or what's called ergodicity. Is like you don't know over your lifespan if it's going to match up to that ensemble average over the last 100 years. Because we can go through periods of multiple decades of being underwater in stocks or even 60/40 portfolios. And if that's during your prime earning years, you definitely now have sequencing risk when you're planning for retirement. And I think that's the thing we don't think about most. But more importantly, what I was saying is like when 2007, 2008 happened, what really happened in people's portfolios is they went down, the stock market dropped over 50%. Well, people really capitulated out of fear at the bottom, right? They called up their financial advisors and said, I don't care what you say anymore. Get me out of everything. I'm going
hmm
to cash. I can't sustain this anymore. And usually, historically, that happens right at the bottoms is when people capitulate the most. So now they crystallize those losses of like down 30 to 50%, depending on what their portfolio construction was like. And then they're so gun shy, they're going to miss that rebound if we do have mean reversion. And so what they've done is absolutely destroyed their compounding. And this is why behaviorally we can't necessarily handle this stuff. That's why I think it's very interesting if you have like tail risk puts or where you're using options to kind of cut off that left tail of drawdowns. Most of this literature, financial literature, shows that people really start to panic at worse than like negative 20% drawdowns. So let's say you use options to curtail that negative 20% drawdown and beyond, and you're willing to let it draw down to that point. But beyond there, you kind of cut it off with these optionality you can use. Is that allows you to think clearly during these times. That allows you to stay the course. But then more importantly, that can allow you to rebalance into those offensive asset classes at lower NAV points, which actually increases your compounding over time. But more importantly for me than anything else, it helps you sleep at night and not panic when everybody else is panicking.
Yeah, it makes a ton of sense. And I mean, I think JP Morgan, they have a chart where they show like the average investor return, and it's basically like CPI. And I mean, I think that the reason that happens is because people capitulate at bottoms and tend to sell out. And I think it's easy to say to yourself that, hey, I'm always going to stay the course and I'm never going to sell out. I'm not going to freak out during those events. But when you're in it and like you're losing your job, your neighbor's losing your job, you're reading the
Yep.
news and it sounds apocalyptic, it's a much different proposition to try to stay invested through that.
Yeah, there's three things I think about that. One is, that's what people that didn't weren't old enough or didn't live through the great financial crisis is, and if we can try to reflect and go there, it's like we thought the entire banking system was going down. Like the stock market might be halted, like we weren't going to get cash out of ATMs. People don't realize the pain of that. So I can't stand when I have like young guys always tell me if the market's down 50%, I'm a buyer. And I'm like, you're just delusional because like Jason Zweig said it best. Like I can draw you a picture of a snake, but if I throw a snake in your lap, you're going to react very differently. And so, like you said, is if everybody thinks the world's ending, you think the world's ending. I mean, you're just like you're basically in the fetal position on the floor. You're not making those clear-headed decisions that you think you would be making a priority. It's just a different environment. You become a different person, and people don't realize the aspect of that. Understandably, that's why it's better to have a systematized process. The second one is you mentioned J.P. Morgan. Actually, if you read like House of Morgan, the original Pierpont would talk about like it was during 5 recessionary times when he made all his money because he was the only one left with cash. So he was the only one that could think clearly. And then he was the only one that could dictate terms during those drawdowns or recessions. And he always talks about that's where he made all of his money. And then the third one is Fidelity's like Magellan Fund. Like you're saying, the average investor probably makes CPI. Well, I think, what is it? Peter Lynch was well up, like well over 20%. I
Oh
think
yeah.
Kager over the time he's at Magellan Fund. It's like it's
Yes.
28% maybe. But they
Yeah.
did a study. The average investor was only up 2% in the Magellan Fund because they were obviously trying to time it, and they were counter-cyclically, they were on the wrong side of that timing mechanism. And so that's what we show all the time, and people don't like to hear this, is one of the best things for financial advisors is what you could call the babysitter tax, right? They keep you from being too emotional and doing those stupid things because the average investor, depending on different studies, loses anywhere from 2 to 8% to the market just from trying to time the market because they get very emotional about it. But people don't like to hear that. But like we have to assess our own, foibles, mine included.
Yeah. Yeah, totally. So thinking about how to make a better portfolio. So I've heard you talk before about Harry Brown. So like I'm a big fan of Harry Brown. I read his book. So how have the ideas of Harry Brown and like the macro quadrants, how has that influenced your approach?
Yeah, Harry Brown was like the first person in modern times, allegedly, to really put forth this idea of a broadly diversified portfolio from the way we conceptualize it. So he was writing in the 1970s about the four quadrant model. And the idea, though, of a broadly diversified portfolio goes all the way back to the Talmud. So it's not necessarily anything new. It's just the modern versions of more Harry Brown. And it actually started with, Alfred Winslow Jones that started the first hedged fund before they became hedge funds, was the idea where he would go long and short, too. So that was actually these ideas started coming, I believe, in the 1940s with Winslow Jones. But Harry Brown talked about the four quadrant model. And his idea was that everything in the kind of global macro environment hinges on the axes of growth and inflation. We're either in growth or recession, inflation or deflation. And the cross currents of both those axes create like a four quadrant model. And the idea, though, is within that's kind of like a Venn diagram. It can be overlapping a bit depending on the different environments we're in. But the idea is you want to be able to cover those four quadrants. Eventually, kind of Ray Dalio copied a lot of Harry Brown's work in my mind and didn't give him any credit. And then he just kind of what he called vol targeted the different asset classes and called it risk parity, right? It's always interesting to me. People don't like to publish the antecedents to their ideas, but Harry Brown's idea was, okay, for growth, stocks tend to do well. In recessions, cash does well. In inflation, gold does well. And in disinflation, bonds do well. You want that kind of income stream. And so this was really great for the 1970s, given the asset classes you can invest in. And if you follow the permanent portfolio since inception, it's done incredibly well. It kind of just muddles along in any kind of global macro environment, tends to clip off anywhere from, 4 to 5, 3 to 5% real returns, which is unbelievable. This is why I said earlier, I hesitate to say investments. It's really your savings. And what you want your savings to do is be there when you need it most and outpace inflation. So if a permanent portfolio can keep you from panicking and doing anything stupid and still outpace inflation by like 3% annualized or on a CAGR basis, like that's a beautiful thing to me. But for other people, it's not sexy to have like a 6, 7%, nominal return while the stock market's ripping, like we were saying, when it's up 10x in the last 15 years. And so Harry Brown's permanent portfolio was as a fascinating way to look at markets, so you can kind of muddle along as anything goes. And what he did is he just split them into equal buckets. So it's 25% each: stocks, bonds, cash, and gold. Now, fast forward to 50 years later, the way I kind of look at it is like, if Harry Brown had the tools in his toolkit that I have now, like I think maybe he'd think about it a little bit differently. So for growth, we use not just domestic stocks, but we use global stocks, which has honestly hurt us. And as you know, it's like the U.S. market has ripped and outpaced international markets for the last 15 years, but we'll see how long that lasts. For recessions or liquidity crunches, this is where we use long volatility and tail risk. Because I love cash. I mean, cash is a great thing, but you have to hoard a lot of cash for it to work. And it's hard for people to hoard a lot of inert cash. So when you think about long volatility or tail risk, it's kind of like insurance. You just put up a small amount of premium that has unbelievable convexity when a sell-off does happen. And so it puts this convex cash amount on your books. So with the kind of how pervasive markets are today and how quickly we can have those sell-offs, like we started talking about the 1987 crash where it went down 20% in a day, is I really like the convex position you get from like tail risk hedging. And so that's how we kind of offset the stock bucket is for those recessionary or liquidity event times. For inflationary times, we use commodity trend following because I feel it has a higher beta to inflation than just gold does. I mean, gold's an amazing thing. I mean, going back, thousands of years, and you can use all these metrics like the amount of gold required to buy a suit of armor during the medieval times is the same amount required to buy a bespoke suit from Savile Row. Like, so gold has kept up with inflation over the thousands of years. The problem is gold may not keep up with inflation in the intervening quarters or years. And so that it has it's kind of variable. And, we can argue about gold all day, but that's the way we feel that commodity trend following, we can go long and short those commodity markets globally. Those are your inputs usually to inflation. So we kind of like that better as an inflationary hedge. And then in that disinflationary or deflationary environment, we use global bonds. And we call it our income bucket as well, because what you want is kind of deterministic cash flows during a disinflationary time. And so that's kind of the modern version. And then going back to gold is like, we also added a little bit of what we call fiat hedges with gold and cryptocurrencies. And the idea there is like, if global, markets shut down, you have war, diaspora, those sorts of things. Historically, those are the things you wanted, like physical gold. And, as the Bitcoin maxis would argue, it's a digital version of physical gold. I don't know if they're right. I'm not going to argue that. You just can hold, 2% of that as a good hedge in case they are right. And so because we're trying to manage multi-generational wealth, and this is why we call it our cockroach strategy, is we want to survive anything. And so that's why we put a little bit of that fiat hedge in there as well.
Awesome. Yeah. So for Harry Brown stuff, I agree with you about the permanent portfolio. It is impressive how it holds up. It's also very impressive how it keeps you sane during those tough times.
Yeah.
Like I think like '08, I think it was down 5%, it's incredible. Like to be down 5% when the market's down 50, you can really sleep at night if you have that kind of approach. I'm interested in so you talked about the commodity portion. So like Harry Brown's idea was gold was the main asset to use there. You're using commodity trend following. So like, what does that look like during different environments? Does that like really, I would assume because it's trend, it really keeps you out of commodities when they're really doing terribly, like the mid 2010s or in the late 90s or that sort of thing. Like, is that the idea there, to be able to capture most of the upside when they're ripping and then kind of limit your losses when they draw down?
Yeah, yes and no. The interesting thing is actually, and I'll tie this into what you just said about the permanent portfolio, right? In 2008, like you said, the permanent portfolio did incredibly well for ballasting your portfolio. And so it started to become a little bit popular after the GFC. What was interesting is in 2022, it didn't do well, right? Because stocks and bonds went down together in 2022. And, gold didn't necessarily pick up, and then you're sitting on that cash. So you had a lot of those risk parity or permanent portfolios have their biggest drawdowns ever in 22. And so people kind of panicked out of them. So it'd be interesting to see how those do moving forward, right? As they got more and more popular, it's like one bad year, worst drawdown ever. People kind of rush out of it. That's always interesting to me in general. It's like people don't realize just volatility in the arrow of time. Your largest drawdown is always ahead of you. So whatever back test you use, that's not going to be your max drawdown. It's always going to be ahead of you, as Mandelbrot would talk about the volatility in the arrow of time. Over the longer time horizon, you're going to see the full distribution. The reason why we like commodity trend following is not necessarily when commodities are doing good or bad. The whole point is you can go long or short. So if commodities are going down, you're going to be on the short side of that trade as well when you're trading managed futures. Where commodity trend following gets hurt is in whipsaw markets, right? Because if they're just trying to buy breakouts, right? You're trying to buy high and sell higher, or you're trying to sell low and buy lower. It's the opposite of value investing, which is like kind of mean reversion. This is the idea of breakouts tend to extend, and that's why it's called trending. And the idea there, like you said, you're buying on the breakouts up and you're buying on the breakouts down. And the part you get hurt is on that kind of mean reversion or whipsaw markets. And so to your point, in 2010s, it was a really tough environment for trend following, after people piled in, even after the GFC. And, the stock market was ripping, as we just alluded to in the 2010s. But what I do find fascinating is if you look at like the SocGen trend index, it actually carried at about a plus 2% CAGR over the 2010s. And so people go, oh, the opportunity cost, right? I wouldn't want to have held that. But if you can use capital efficient overlays, that to me, that's beautiful. You had this defensive asset class as a hedge for like an inflationary or recessionary times that carried positively through the 2010s. It's just you have to get a little bit more creative about how you can use capital efficiency and provide that as an overlay. And I'm sure we'll get into that. But this is why I think commodity trend following is fascinating, is you're trading, upwards of 60 plus markets globally. And what you're doing, it's more of those commodity inputs. Like you're looking at the entire metals complex. You're looking at the entire energy complex. You have all these agricultural products with like softs, from grains to cocoa to coffee. You also have all your meats. You have your feeder cattle, you have hogs, you have pork bellies. And so it's all of those raw commodity inputs that can be really, really affected by inflation. Those are the markets that you're trading long and short. And what it does is it provides historically an uncorrelated asset classes to stocks and bonds. But I want to be clear, uncorrelated means that, half the time it's correlated, half the time it's uncorrelated. And these are conditional correlations. But where they tend to really pick up, like I was saying, is tends to have a higher beta to an inflationary time. So in 2022, when stocks and bonds were going down together, and this is actually an interesting thing to think about, is, during the last 40 years, stocks and bonds have been negatively correlated. And that's why 60-40 did incredibly well. Well, if you look at a longer time horizon of 150, 200 years, the majority of the time stocks and bonds are correlated. And the time they tend to be correlated is during inflationary times. And so, they tend to go down together during inflationary time and have high correlation to each other. But then that's when hopefully commodity trend following will have a higher beta to inflation. And hopefully that helps ballast or offset the kind of rest of your portfolio.
Gotcha. Yeah, that makes a lot of sense. And 2022 is a really good example. I tend to think those risk parity style portfolios won't have another drawdown like that simply because like in the near term anyway, simply because you can only have that move from 0 to 5%, the income side. That can only happen once, It's not like rates are going to go up to 20% in the next years. Well, watch, that'll probably happen.
Yeah, exactly. Yes and no. It's hard. It's how quickly, like, and we should define risk parity in a sense, like if people are just thinking about stocks and bonds, where like true risk parity should go into commodities and everything else as well. But stocks and bonds, it depends on how quickly they can move, because like the hard part is if you're most of the stuff in life, right, you're looking in the rear mirror when you have to drive forward looking through the windshield and your headlamps. Well, if you're attenuating your portfolio to a low volatility environment, you might be really leveraging up those bond positions, right? That's what risk parity would tell you to do. And then if you had a sharp event and you had a real drawdown in both of those, that's where you can get completely blown out, because you might have a lot of leverage on the bond side. So if you go back to like the 1930s, I think risk parity likely would have gotten entirely blown out, because a 60-40 portfolio historically allegedly was down like 63% in the 1930s. So depending how quickly you're degrossing or deleveraging the bond side, you might have been able to survive it. But if it was just stocks and bonds and you were running a higher leverage because you had a quiet environment, and this is why I always talk about with like Minsky moments, like Hyman Minsky, is like stability breeds instability, because over time, the more stable the market environment is, the more and more kind of returns come down, and the more and more people are willing to take risk and leverage to try to get to the same historic returns. And so we just look at a shorter time horizon. So it gives us the comfort that we should be able to leverage up these positions. And that's why that stability eventually breeds instability, because it just takes the tiniest pinprick to really burst that bubble.
Gotcha. Yeah, I was more talking about like the unleveraged, like Harry Brown style. But you're right.
Yeah.
I mean, if you're applying leverage to that,
I agree with you.
Yeah, it can definitely result in some catastrophic consequences.
I think that you're hitting on a great point. That's why I want to clarify the difference between risk parity and Harry Brown's permanent portfolio. Is risk parity would say we look at the asset classes and their variance, sometimes called volatility, but I really try to say variance because that's what it is. That would get you to leverage up the bond side. Where Harry Brown's permanent portfolio was just equal weight in those four asset classes. And that's why I'm a much bigger fan of Harry Brown, because it's more like a lot of stuff that can happen that maybe isn't in the historical data set that I'm using. And so I just need to be much more prudent. And that's why, but people then look at like that bond side and before 2022 and are like, I don't have any risk here. So like I should lever this up as much as possible. But that's a clear differentiation. Was Harry Brown was much more robust, but once again, much more boring, is why people don't necessarily like that permanent portfolio.
Yeah, you can't build Bridgewater with the unlevered, Harry Brown portfolio.
Exactly.
You need to,
Exactly.
yeah, I got you. So very cool. So I think, so another question I have. So this cockroach style portfolio, I know that's just like one of your strategies, but like thinking about that cockroach style portfolio and applying something like commodity trend following to it, which did awesome in 2022. I'm curious, like how did that overall portfolio hold up in an environment like 2022, where stocks and
Yeah.
bonds are both
So
going down?
Yeah, so by the way, the cockroach strategy is our best thinking, right? That's our total
Hmm.
portfolio solution. Everything else we run are just sleeves of that. So if people want to choose their own adventure, they can. But we truly believe in the full portfolio of having that total portfolio solution with all those different asset classes in it. 2022 was fine because we still experienced a drawdown because you had such a large drawdown in stocks and bonds.
Hmm.
And in that environment, long volatility or tail risk doesn't perform particularly well, but the commodity trend following did. So that's what I'm saying. It was a real ballast to the portfolio. But more importantly, what you're doing is you're reducing those drawdowns. So when the market turns and comes back up, you don't need to make as much money to get back to your high water mark or past break even. And that's kind of the key to this, right? Like people don't realize if you lose 50% in your portfolio, you have to make 100% to get back to even, not 50%. And that's
Yeah,
that volatility tax you get from drawdowns that people don't think about when they're compounding their wealth over time. And so to us, we had like single digit drawdowns in 22 compared to like, going into that, depending on what the construction of your portfolio was, anywhere from 15 to 25% in like kind of stocks and bonds, depending on what your kind of exposure was to both of those. So it's really trying to just mitigate those drawdowns. And that's what really affects your compounding over time. Unfortunately, the entire industry always thinks about your arithmetic returns or like your annualized returns, but through time we have to compound those returns. So it's not addition, it's multiplication. And so that's where that volatility tax or drawdowns really tends to hurt you. And so if you can mitigate those drawdowns, the upside will take care of itself, but it allows you to get back to that high water mark or get back to break even much faster than kind of any other portfolio can.
gotcha. Yeah, I think that's a huge concept to understand is that, it takes it takes increasingly heroic and escalating returns due to the extent of your drawdown. Like it's not just that I'm down 50%, I need to make 50%. No, you need to make 100%. And then as you go down from there, it gets even crazier and scarier with the kind of returns that you need to make up for that. So the other sleeve of the portfolio I'm very interested in is long volatility. So this is for I would assume your more deflationary scenarios, your 2008s, that kind of thing. So how do you guys implement long volatility into the portfolio?
Yeah, the easiest, I mean, this is the much more esoteric version of our portfolio that people aren't accustomed to. And it takes a bit of an education curve because, we're talking about derivatives and you have to know your options Greeks. And then I'll try to distinguish between long volatility and tail risk. So classical tail risk is what maybe a lot of people can become familiar with Nassim Taleb. And the idea there is it's very similar to insurance, right? We all own home insurance, car insurance, life insurance, but for some reason we don't have portfolio insurance, right? And as Nassim Taleb said recently, it's like if you don't have portfolio insurance, you don't have a portfolio. And to me, what he means by that is like imagine having a coastal beach house that's 10 to 20 million dollars and not having hurricane or insurance on that house, right? Like you don't have a house, right? Unless you can hoard enough cash to be able to rebuild, you got a serious problem. And I think that's essentially what he's saying about portfolios. And the idea there is what I referenced earlier is like you can tie that insurance to like say a negative 20% attachment point. And then you pay your premiums just like insurance. And most people don't like to do that because it's an annualized bleed, right? You might bleed 2 to 3% a year paying that insurance. And this is why people can't necessarily hold this over the long term, especially if the market's just been up and to the right for a decade, right? It makes it to look at that line item, you go, how am I helping my portfolio? But this, once again, you have to think about the compounding over your life horizon. So the idea there is like you pay that premium. You use that negative 20% attachment point. And what that means is like beyond negative 20%, you're kind of covering yourself against any losses beyond that point. But if you have a 5 or 10% drawdown, you're going to eat that, right? That's your deductible, right? If you think about it that way. And so what it does is going back to us psychologically and behaviorally, it's beyond that negative 20% where you really tend to panic and make bad decisions. So we want to cover that point. And you can be willing to kind of eat the bleed of a negative 5 or negative 10% drawdown, because otherwise it'd be too costly. The premiums would be too high to kind of cover that. So that's your idea of like kind of permanently on tail risk. And you want to have that permanently on because like you don't know when that event's going to happen. Like we haven't seen a true flash crash like 87 since 87, but potentially that can be in the future, and it could be worse than a 20% drawdown in one day. So that's what we really try to think about for permanently on like tail risk hedging. So the idea, though, what I said is like people don't like that line item cost of perpetually paying that premium for their insurance. And so what long volatility managers have done is they've tried to time the market a little bit better, right? And so maybe you don't want to eat as much of that bleed. So maybe you like a forest fire, right? You're looking at what's the underbrush look like? How long has it been since the last rain? Are wind speeds picking up? Has PG&E trimmed, around the trees recently? No, like, so you're looking for those times when you think it's higher likelihood or higher probability that a forest fire could spark off. And that's when you're buying those puts. But you also might be buying calls. So because you're kind of looking at both tails to try to make some money off of both tails. You're just looking for that volatility or vega to pick up. And so that's the way long volatility works. It's just a much more opportunistic, maybe version of tail risk hedging. And the idea, the way we think about it is you kind of have this triangle of carry, certainty, and convexity. And the idea of carry, like I said, premium means a negative carry, like you're stroking that check for that bleed. So you might want to reduce that. But then certainty means like if it's permanently on and I have this in a listed exchange and it's tied to my S&P exposure, I could be pretty certain that's going to cover that loss. And then convexity is like how much like how far out of the money, like how much are these going to explode to the positive side when we do have a sell-off. And the idea with those three things of the triangle or our three-legged stool is you can usually only choose one or two out of three. You can't get all three. So when I talked about tail risk hedging, you have high certainty, high convexity, but you have a negative cost to carry. So if you want to go more long volatility opportunistic to limit that kind of cost to carry, well, now you might be able to maintain the convexity, but you have less certainty, right? Because if you're trying to time the markets, right? And let's say your models didn't have you in the market in over a weekend, we have some sort of war spark off or some sort of crisis in the environment or something like that, or a terrorist attack, you might not have been in the market. So you lost your certainty over that weekend. And because your models weren't telling you that anything was going to happen. And so we try to think about that, how to overlay and overlap different managers to kind of cover a lot of those risks and that path of moneyness from at the money to out of the money to deep out of the money. The other thing we use is what's called vol relative value. And the idea there is in volatility relative value trading, you're trading either, the VIX calendar spreads for the futures, or you're trading the intramarket spread between VIX and S&P. And this is what goes back for me back to like 2012. And the idea there is it's more of a pairs trade. You can think about it like pairs trading in equities, like going long and short, that sort of thing. And the idea with pairs trading and volatility is you can hopefully try to make some income by the distribution of that pairs trade and going long and short. And hopefully we use that to hopefully help pay for a little of that premium bleed you get in that long volatility and tail risk. But we still search for managers that can flip and kind of go long volatility, even though they might be market neutral on that pairs trade. Then there's other ways of looking at it as you can use, what happens with options creeks is, you have a sell-off like March 2020. Well, you went from a low vol environment to a high vol environment, and now your premium is going to dramatically expand, or you get vega expansion or implied volatility expansion. And now you're paying a much higher premium to try to cover any losses. And so that becomes precedingly difficult for a second leg down. So what we do is we look at what we have these intraday kind of trend following managers that can go short the market indices around the world using managed futures. And they don't have to pay up for that implied volatility. It's just a directional bet, which we call Delta 1. It has the similar delta to the market. So they can just short that. So we kind of look at our long volatility or tail risk ensemble across kind of those four different buckets. And we build an ensemble approach of 14, 15 managers to make sure we capture a lot of the eventual events. Because like I was saying earlier, if you're looking through the rearview mirror, you're fighting the last battle, well, the next sell-off's not going to look like the last sell-off. So a priori, you can't know what that sell-off looks like. So you need to be able to cover as many path dependencies as possible. And then more importantly, if these things only happen every 5, 10, 15 years, you got to make sure you monetize that. And so the hardest part with these things, it's very easy to put on an options trade. It's just how do you roll and monetize it that becomes a little bit more tricky or difficult. So that's why we believe in this ensemble approach, because if an event happens and 4 or 5 of our managers don't monetize it well, we still have 10 other managers that might be monetizing it much better. And so through this ensemble approach, a broad diversification across this asset class, I'm just trying to create like a beta return signal from this asset class bucket. And similarly with the commodity trend following side, we can get it. There's large dispersion there, and we use an ensemble approach and managers there as well, because there's just no investable market for long volatility, tail risk, or commodity trend following. That's very easy to get a broad ensemble. So we just build that ensemble because I don't necessarily believe in alpha. I'm just trying to get a beta signal from that space in general.
Gotcha. Yeah, and I like the comparison to insurance, and you're right that most people want insurance after they want flood insurance after the hurricane just came through, which is probably too late to have it. That's very cool. And then for the other sleeves of the portfolio, so I mean, you mentioned with stocks, you're globally diversifying stocks. Like, what other kind of segments of the stock of the stock market are you going into for that like prosperity leg of the portfolio?
Yeah, so we're technically a commodity pool operation, so we try to use only managed futures and derivatives of managed futures in the futures markets. But what that allows us to do, we were talking about earlier, the kind of the unsexiness of the permanent portfolio compared to like maybe what your neighbor has when you're trying to keep up with the Joneses. So I've always wanted to just like, if you just use like 2x leverage on a permanent portfolio, then it can keep up with those other portfolios. Maybe it's a bit sexier. So in ours, we have equal weight in those 4 quadrant buckets I was talking about, but we can use that capital efficiency you get where you don't actually pay up for that leverage in those futures markets. So we're actually, instead of 25% each of these buckets, we're 50%. And I say that because what that allows you to do is if we're 50% in our long volatility and tail risk and 50% in our commodity trend, well, you're getting 100% exposure to the defense. But then in-house, we can overlay 100% exposure to your offense with your global stocks and your global bonds. And so I bring that up with the managed future side. One, the capital efficiency, and I wish people could learn more about those markets, because we basically pay like overnight lending rates like SOFR or upwards of 3 months T-bills for that quote unquote capital efficiency or leverage, and it's baked into the term structure of futures. So it's not like you go out to your broker and you borrow at 8 to 12% and you have to pay them every month. No, it's just baked into the contract. So it's a bit different. So I want to clarify that. The other reason I bring it up is because we are a commodity pool and we really just trade in the futures markets. That means that we just use the global market indices. And so we are broadly diversified globally, like we said, across US, developed markets, and emerging markets globally. And as you know, that's dramatically underperformed for the last 10 to 15 years. But historically, actually, if you look at the long historical average, global markets ex-US have outperformed 53% of the time. It's just in the last 15 years, it's only been, or 20 or 40 years, it's only been like 14% of the time. And so we believe the right thing to do is that global diversification. But then even domestically, we're even diversified across S&P, NASDAQ, and Russell, because there are futures markets for those indices as well. So that's on the stock side, it's that domestic diversification and then global diversification using the market indices we can use in the futures market.
Yeah, and I'm in agreement with that. Like, I think it's when you think about an index fund, you're like, I can't predict which company is going to perform the best, so I'm going to own all of them. It's kind of the idea. I think you could apply the same thing to countries. Like, we don't know what country is going to perform the best over the next 10, 20 years. So you might as well diversify among a lot of different countries.
I think it's fair, though, that there's arguments, right, that the U.S. conglomerates are global conglomerates, so you don't
Hmm.
maybe need as much global diversification, and that all of the global markets now have a pretty high beta or correlation to each other. I think it's a fair argument. I mean, we'll see moving forward, but I think it's actually more in the bond side with the global diversification of bonds. That's where you get much more idiosyncratic exposure and uncorrelated exposure to the countries than you necessarily would in the stock market. But I think going back to stock market, and I might be front running your next question, and then people usually ask us about factors. And I think it's interesting in factor side is like you're still going to maybe in the commodity trend following, you're still going to get a factor exposure to like momentum and trend on that side. But
Hmm.
then like maybe we're not getting exposure to like value or quality necessarily in market indices. But I would argue you're getting exposure to whatever factor has a recency bias for working, right? And as we know, it's like the Mag 7, Momo trade has been what's working. But if you have a cataclysmic event like 2000 in the stock tech wreck or 2008, value will actually rise back into vogue on those indices, right? It just usually takes a really difficult event for it to transition from, momentum or growth to value. And so
Hmm.
you still get a bit of that in the indices. It's just, can you handle that cataclysmic event? And that's why we have to think about the emergent qualities of the rest of our portfolio is, yes, we have this tail risk hedging that should allow us to rebalance into the stock market as it draws down. And then more importantly, it might shift more from growth to value during that time frame. And then we'll have more exposure to value. So it's almost like the factors kind of work themselves out in a way as far as we think it from an indexing perspective.
Cool. And then for bonds, so you've talked about this a little bit. You're globally diversifying bonds. So traditionally, for like the Harry Brown style, he would mainly say, only want to be in treasuries. So what would be your response to that? What would be your response to saying, like, I want to own bonds from all over the world versus just focusing on this one slice of the asset class?
Yeah, there's a couple things to think about. One, when we were talking about risk parity when you lever up the bond side, well, there's different ways to think about bonds. You have to think about the duration of your bonds, which gives you different sensitivities, right?
Hmm.
If you have a 1 to 2 year, bill or a note, you don't have that much sensitivity as rates move around. But if you have the 30-year or the ultra bond, it has a much higher sensitivity. So one could
Hmm.
argue that's leverage. But what people don't realize is maybe in 60/40 or using ag as your bond proxy, durations have usually come down over time. So you're usually only like 6 to 7 year duration in that portion of the bond. So what one we target is much more like a 15-year duration, which is much more like in line with Harry Brown, which might be arguing that's where you get much more of the maybe risk parity or leverage on the bond side. It's just, Harry Brown thought long bonds just provided a better ballast in those environments. And then I think maybe it was just much harder during the time in the 1970s to buy global bonds. And so that's why I think if Harry Brown were alive today and had the toolkit that we have, he might think about it differently. And at the end of the day, I'm always going to go for broader diversification and an ensemble approach because a priori, I cannot predict the markets. And so this is why we use global bonds. We also target that duration of 15 years, but to be clear, that we actually layer exposures from 2 years all the way out to 30 years. And so we're all along that kind of treasury curve, but then we're also using that higher duration. And that's the ballast for the portfolio. And like I said, it's tough to talk about bonds, given 2022 and the recent environment. But the idea is none of us know when bonds are going to return, and was it 1982 certificates of confiscation? People tend to predict wrongly about these markets. So this is why we try to hold that. And we have to think about the emergent qualities of the rest of our portfolio. So like generally, I think about it as like most of the time, like we were saying, equity and debt works, right? For the most part of the time, but they're very linear instruments to me. So you can have a 10-year period where they're just slowly going along up and to the right, like the old adage of like, the market takes the stairs up, but the elevator down. Well, those linear environments like stocks and bonds do really well. That's great. But then we have these convex instruments that kind of offset those environments, right? Like I said, for the stocks, we're using that long volatility and tail risk. But for bonds, the hedge, they tend to do really poorly in inflationary environments. Well, now we have commodity trend following to help offset that has a little bit more convexity to those environments. So it's also about pairing the linear with the convex. But so I like the broad diversification that we can get from global bonds with a little bit higher duration than most people are accustomed to. But then we also try to use other strategies that will provide more deterministic income streams. Like on the bond side, I don't have necessarily a problem with using private credit or private debt because what you're really looking for is just income stream. And so it's about underwriting that income stream because in a disinflationary environment or a slightly deflationary environment, you just want those cash flows. So I think it's maybe incumbent to think about those maybe outside the liquid markets. It's nice to have that kind of private mark to model where now you're getting maybe the advantage of volatility laundering and you're not as panicky about like the recency bias of bond returns.
Awesome. And you mentioned earlier when we were talking about tail risk and long volatility that you might want to like look at the conditions on the ground. Like you know, is volatility high right now? Is the VIX high? Is it low? What are the conditions for, a big event? So to what extent do you try to time that kind of thing in your models? And to what extent do you kind of keep things static where your attitude is more of like, I can't predict the future and I'm going to stick to these allocations?
We're such, get one of my favorite questions is like, tell me what's going to happen in the markets in the next 6 to 18 months. And it's
Yeah.
it's my favorite answer is because I get to say, I don't know. And that's very rare in our industry. And fortunately, unfortunately, I get invited to speak on stages all over the world at these events, and all the global macro guys get up there and they predict the future. And I get up there and say, I don't think any of these guys can predict the future, and they don't have a history of predicting the future.
Yeah.
And I can't predict the future. So we try to prepare, not predict. And so that's why we just think about, diversifying these buckets of offensive and defensive assets. And then going back to Benoit Mandelbrot, we believe in like fractal diversification. So not only we think about offense and defense, then we think about correlations, correlated, uncorrelated, negatively correlated. And then we think about the 4-quadrant model. And then inside those 4 quadrants, we broadly diversify inside there. So it has a fractal nature to it. So that's why we believe in broad diversification. And I say that is because I don't have a crystal ball. So you don't want me to predict the future and attenuate the portfolio's allocations based on what I think the future is going to be. So we don't bother with any of that. And then related to the vol space or tail risk space, what I do think is interesting, I'm a big fan of kind of fixed spend on your tail risk or insurance hedging. Because as I mentioned earlier, with the Hyman-Minsky, stability breeds instability, is typically your tail risk gets cheapest right before the event. So some of the cheapest environments we've seen for tail risk hedging are 2017 and 2019. So that tail risk hedging was getting cheapest right before that 2020, which is a great feature you get kind of from tail risk hedging. Now, the problem is that can go on a lot longer than you expect, right? Like there's going into prior to 2007, I think we had 1,400 days without a negative 2% down move in the S&P. So you might have thought, oh, it's right around the corner because we're in a low vol environment. Well, it can last for a year. So I don't try to time that either. But the idea is if I just fix spend on that insurance, I'm loading up usually right into the event. And then after the event, like I said, that implied volatility expands, those premiums become much more expensive. You want to keep that fixed spend lower, right? You're not going to have as much protection, but like you get that fixed spend. And so that's the way we do think about it. And to give you an idea, sitting here right now, like the end of 2024, we're seeing pricing for tail risk hedging that's very similar to 2017, 2019. So we're seeing some of the lowest prices in history for that tail risk hedging, which I love to be able to get those low prices. It doesn't necessarily mean the event's right around the corner. It can go on much longer than I would expect. And so I have no idea how to predict those markets. One of my favorite quotes is from Jerry Hayworth that runs 36 South. That's a volatility fund. And he's like, I can't predict the markets, but the best predictor I have is when we're getting large amounts of redemptions from our clients. When they're capitulating, it's usually right before the event happens.
That's awesome. Okay, so in thinking about how investors can implement some of these ideas on their own, like a DIY investor with like a Schwab account, like what are some of the ways that a DIY investor could implement some of these ideas on their own?
Yeah, so one, I'm still a huge fan of Barry Brown's permanent portfolio. I wish more
Hmm.
people knew about it. And maybe that's the easiest way to implement some of these ideas and maybe a more simplistic, but also a robust way of thinking about it. I think that my buddy Med Faber has done tons of great research if you read his stuff about everything from permanent portfolio to Ivy League portfolios to all the different iterations of those. And it shows as long as you get like kind of broad diversification, that they all kind of end up at kind of the same place, right? Over the long term. So it's not necessarily, you don't need to get too crazy about the iterative aspects of it or the details. It's like just start thinking about offense and defense and maybe broader asset classes. The other way to I think about it is like I was fortunately or unfortunately raised by a hardcore capitalist entrepreneur business owner and then a dirty hippie Buddhist. And so I have both of those aspects to me. And so I set out to, want to build these institutional quality portfolios for family and friends that maybe didn't have the institutional size money. And so ideally, I would be able to build it for non-accredited investors, everything like that, so they could start out with these broadly diversified portfolios. But even in our space, our product is for accredited investors only. And I say all that because like I really wish I could stuff what we do into an ETF. I really wish we could do it. You just can't. And I don't know what you need to do, write your congressman or whatever, but like it's just not possible to necessarily do these products. I've had friends that have tried valiantly to include like tail risk hedging into their products. The problem is the way that the regulations work, it has to be very systematized. And a lot of times when you have a very systematized process, you're buying the most expensive parts of the ball surface. And it's very hard to do this. Like that's why I think like long volatility and tail risk and commodity trend following are maybe the last bastions of active management, because that's what it takes. Like it takes kind of man plus machine, that centaur, to kind of one, have a systematized process and have all large data sets, but then also get creative about where you see opportunities on the vol surface or where you see mispricings. And so there are like, I would, like I said, I recommend permanent portfolio. If you search out there legally, I can't give you any tickers or anything, but there are ETFs and maybe other products that might incorporate a bit of commodity trend following or tail risk hedging. And I think that there's you probably don't know this, there's a huge contentious debate in trend following on whether these trend following ETFs that are replicators are similar profile to classical trend following with a separately managed account. I'm happy for both. So I kind of cross over there a bit. Is like, I think that any version, even if you're trying to replicate trend following and it's maybe not going to produce the same P&L, I'm happy that those exist in the ETF form. And I'm more happy that those are bringing more people to the space that realize they can get access to these products or these asset classes that may be uncorrelated to the other things that they're investing in.
Very cool. And what would be some of your advice to someone who is like, well, I'm content with a typical 60-40 approach? Like, what would you say are maybe some of the things they're missing?
As one of my friends once said, I try not to give advice because I don't take any. In the sense that, like, I always think of like, what they always say, what advice would you give your 20-year-old self? And I'm like, are you kidding me? That asshole will never listen to my 46-year-old self, right? Like, he's just not interested. And so I don't have individual advice. And I kind of flip it around. It's like, what I think is interesting is like, I can't convince anybody off the street that has a 60-40 portfolio that they should do something like we do. What I try to do is I try to find the weirdos that are like me, that are out there, that are maybe the 1 to 3% that are looking for something like that we built. And so, if they're content with their 60-40 portfolio and their financial advisor and, what's worked for like the last 40 years, who am I to dissuade them from that, right? Like, I just think it's a no-win game, and I'm just beating my head against the wall. So what I do these podcasts and everything is I'm trying to find the clients that are weirdos like me. So we're essentially trying to fire 99% of the clients that find us, because we want people that truly understand what we do and are here for the long run to be with us, because it really takes the longer term to figure out that compounding works in your favor over the longer term if you reduce those drawdowns and left tails. And quite frankly, like we started the conversation with, if the S&P's up 10x in the last 15 years, don't listen to me. You should have been the SP 500 for the last 15 years, right? Like, defense was not necessarily accretive to your portfolio. So it's just kind of my knee-jerk reaction to give any idea of advice. Is like, outside of, I don't know, they say you should floss. Maybe I'd do that and do whatever you want with your portfolio.
And if someone wanted to learn more about some of these concepts, what would be some of the good resources or books that they should look into?
Well, one of my favorite, like we said, is Harry Browne. So maybe people should go back and read some of Harry Browne's work and just think those things through. There's also been some great work around Harry Browne. I think Josh Kaufman wrote a great piece years ago about the Harry Browne's permanent portfolio. He's the one that did The Personal MBA, which is a phenomenal book in general. And then, you can go to our site, mutinyfund.com. We've written tons of blog posts, done tons of podcasts around a lot of these concepts. And then, there's people like Meb Faber or Corey Hofstein at Newfound, or, teamed up with my buddies at Resolve Asset Management. They've all been writing great pieces about this for well over a decade. So there's plenty of places to kind of learn about these different asset classes, and trying to think if there's not really a book that all encompassing. We do have a white paper that's free on our site that's about 80 plus pages that goes into detail of every asset class and putting together and what's the kind of emergent effects you get from portfolio construction in this vein.
Awesome. Well, thank you for your time today. And what are some of the best ways to contact you and learn more about your approach to investing?
Like I said, it's mutinyfund.com. That's singular, that you can find all of our great work on there. And then on X Twitter, I'm at Jason C. Buck. That's JASONCBUCK. And then you can find links to all of our stuff from there. And then all the wonderful podcasts I've enjoyed being a guest on, such as this one. I really appreciate your time.
Awesome. Thanks for coming on. Well, thank you for your time today.
Thank you for listening to today's podcast. For more information, please go to securityanalysis.org. Subscribers to the website get early ad-free access to podcast episodes in addition to weekly in-depth profiles of companies.